Welcome to the 10 Mil Club's weekly portfolio video for the second week of August 2026.
From Nashville,
It's the 10 Mil Club. It's the 10 Mil Club.
The 10 Mil Club is an informal group of people who believe that if we could get to $10 million of net wealth, we'd have the financial security that we want. We had a landmark event this week, and that event was that on the 10 Mil Club Facebook group, someone gave us a like on one of our posts. We haven't ever had that before, and I know you're probably thinking, well, I mean, people like stuff on Facebook all the time. That's true, but no one has ever liked one of our posts before on our group, and it was nice to see that someone's out there reading us. We actually have quite a few people watching this YouTube channel and watching our videos every week, for which we're very grateful. Please give us a like on this video. We would sure appreciate it. It helps us in the YouTube algorithm, helps others to find out that we're around. I will put the URLs for the Facebook page and group below once this video is uploaded. So we're looking at a really low volatility market. This is the VIX, and I'm looking at a year of it here. Probably looking at a year of it because this is really super low. So 1425. If you watch Dave Keller like we do, and hang on his every word as we do, highly recommend Dave Keller's Market Misbehavior webcast, his YouTube channel. By the way, he doesn't pay us anything to say that. We just think he's really great. What he gives away free is amazing. But you can actually trade the VIX, just so that you know there are options on it. And it is possible to actually, so on a low VIX like this, far be it from us to tell anybody what to do. But if you were to trade the VIX, you're kind of left to either buying a call option or selling a put option, selling a cash covered put option. Either one is going short volatility, and we haven't seen a turn here yet, but it's kind of like Dave said, if you're waiting for 13 or 12, that's awful low for the VIX to get. That indicates, though, that the market really isn't pricing in a whole lot of trouble in the future. And let's go to SPYM. This is the S&P 500 ETF that we kind of prefer. There are others, VOO and SPY, and these are others that people like. We like this one just for the share price. It's $91.39 a share, as opposed to, however many. VOO is $713 a share, and it does essentially the same moves. It exposes us about the same way, pretty close. And so with SPYM, we just like the share price. We've broken out here and gone risk on, and thus we have some things we're going to talk about in this video that are risk on positions that we're thinking about taking, some that we have taken. So the MOVE index, which is kind of the VIX for bonds, also isn't showing any real trouble at all. This line is nonsensical. I'll remove it. But anyway, so below 70 right here, the MOVE index really isn't showing any problems either. If we're going to take a look at breadth, which just very briefly, this is the percent of S&P 500 companies trading above their 200-day moving average. We are at almost 72%, which is the highest we've seen for the year. Here's an interesting point of fact. This is the percentage of S&P 500 companies trading above their 50-day simple moving average. That's at 69.3%, which actually is not the highest for the year. What that means that enough companies have gone and traded above their 200-day moving average to hit a high, but enough companies have not hit a recent swing high of above their 50-day moving average. So we've gotten some compression there in the middle. It's not a lot. it's nothing to really be too terribly concerned about, but it's just an interesting kind of sidelight and point of fact. We keep these on tap for the day. So SH is when we simply keep, this is a short S&P 500 ETF. Don't buy this right now. We keep it on tap just for the day when everything goes awry and we need to be able to take a position that will go short the S&P 500. Today is not that day. And then PSQ is the short NASDAQ or QQQ. And it's also not something you need to go short. We only keep those around for a rainy day when we want to go short the market. That day is not today. So placid market, seems like it's a risk-on situation. Things are going up. We know the market's very overvalued. And so what we're trying to do right now is figure out some positional trades where we can actually get above market returns. And so with that, let's get to it. ABM is first on our list today. We actually own this, and ABM is just kind of hugging this 21-day EMA, but the technicals are lining up pretty good. It fell for a long time. We bought it up just a slight bit at 3.62%. BNY, Bank of New York Mellon. I'm going to move pretty fast on all of this stuff because there's quite a bit of stuff to cover. If you'd like to know our thinking behind any of it, just post and ask. We'll be happy to talk about it. BNY, we had to gut this out. We bought it a couple of weeks ago and then had to gut out a few days of being down slightly, but it's such a smooth mover that we've been above the 21-day EMA for just about all of it. Now we're up 2.7%, so doing fine. Citigroup may actually come off the list, and the reason is just because it is volatile enough that we've been stopped out twice, and whereas we're up on Bank of New York Mellon, BNY, we can't seem to make Citigroup work all that great. I don't know why. So I think what we're going to do is we're going to take Citigroup off the list and move on. DoorDash, D-A-S-H. DoorDash has these technicals that look like this. Now, just to give you kind of, take me off for just a second here, down this very, very low set of numbers down here, the DMI, we watch that very closely. The RSI, right up here, we watch very closely. Historical volatility on a 10-day window, we watch very closely, and then we keep an eye on relative strength because we'd like to do what we can to beat the S&P 500. But the technicals line up real well for DoorDash. Now, it's above its 21-day EMA, but it's been overbought in the last few days, above 70, and it's looking like it's hitting there again. We may simply buy into this. Side note, every day, what we saw, thought about, did is posted on both the Facebook page and the group. If you monitor those things, you'll know we have found that you don't really need to know in real time what we do, like in the moment, because sometimes we're down for several days afterward. Sometimes we're up for several days afterward. If you pick it up exactly where we do it, exactly the same moment, we have found that it really doesn't make a whole lot of difference. So anyway, DoorDash, looking at DCI. We own this. We are still up 7.21%. It got a little extended, and has just migrated back to its 21-day EMA. This is probably going to be one of the tense moments for the week. I'll probably be watching this really closely in the next few days on my Foursquare. My Foursquare looks like this. I've set up, I don't know if you use Thinkorswim. If you use TradingView, that's fine. If you use stock charts, that's fine. But on Thinkorswim, I can put a Foursquare together like this, and I'll watch it very closely, and so that's what I'll do. But anyway, DCI, just fine, 7.21%, going back to the 21-day EMA. Dollar General, this was last week's tense moment. That is the 50-day simple moving average, right there where it came down, touched it for the day, came back, closed above it, got another day, up, and now we're headed back the opposite direction. So far, we're okay on Dollar General, up 5.5%. Duolingo, DUOL. You simply have to play a different game with Duolingo. You can't see what I'm doing here. All you see is a bunch of junk. I'm going to put up 2 months, 1 hour. Duolingo, you must nail the entry, or you cannot play Duolingo. Not, at least not with the way we work stops. And if you aren't using stops adequately, or you don't know enough about them, we highly recommend that you read books by experienced traders like William O'Neill's book, Mark Minervini's books. What we have to do with Duolingo, because it is so, let me back up to 6 months here. Duolingo right now, that's this middle line right here. Sorry, it's about the middle line down. It says historical volatility. So that one, we've got an 89% historical volatility. That is really high. So with that kind of volatility, we have successfully traded Duolingo once. So I'm going to go back to 2 months, 1 hour here. We picked it up right there at 119.65 and sold it just a few days later at 141.50. And did not, this low right here was salted by earnings, and it took out the recent swing low. And so we kind of made the conscious decision to simply let that one go because we didn't know exactly what was going to happen. It did come, and in a way, this is a new after hours swing high, but we would have done okay on it, but how do we know that? So we salted by earnings. So what we're doing is we're waiting for a new swing low down this way that doesn't have an earnings effect, and that is enough time spent on Duolingo. As of right now, it's just on the list we're watching it. So EXLS, the reason we are interested in EXLS is because of these earnings right here, which happened in late July. We had the lurch, then the dry up of volume like this. As it builds a base, break above that base high, we're probably off to the races, and we're probably buying EXLS. EYE, National Vision Holdings, all of these, by the way, have some fundamental aspect of them I like. I do not pick things. I did not go through the CFA program in order to pick things with cruddy fundamentals. That doesn't mean everything has all the fundamentals I like, but they all have fundamentals I'm at least reasonably comfortable with. This we're interested in because of a dive, EYE, on the earnings right here. As of yet, we don't know what's going to happen. Our strategy, and one that we really kind of picked up through a combination of studying the CMT programs information and Dave Keller's broadcast and anything else, is we're a gap down on earnings, or at least a big down on earnings, doesn't necessarily, especially if the earnings don't seem to make that much negative sense to us. We can't do anything about the stock price. So what we need to do is we need to actually give it some time. Dead cat bounce notwithstanding, volatility notwithstanding, we need to give it a few days. There is no set. There's something called the 3-day rule. Give it 3 days and see. I think that's arbitrary, as is a lot of stuff. You got to wait a year after your spouse dies to date again. Why? It's an arbitrary date. An arbitrary amount of time. And there's a lot of stuff like that in the world. We don't wait just 3 days. What we do is we wait and see until we can see a pattern and a recovery. So EYE is in that category. G, which is Genpact, fell for, let me pull up 2 years Genpact here. So Genpact fell for quite a long time. There's a lot to like about the fundamentals of Genpact. On these earnings, it rose into those earnings and then has kind of held this area right here. Let's go back 6 months. Has kind of held these earnings and has started respecting the 21-day moving average. So for us, G is something we will probably be looking at here pretty quick. GGG, almost exactly the same pattern, up respecting the 21-day moving average. If we see just a bit of a turn right here, might be buying GGG. HCSG, we actually bought this past week. I'm sorry. Graco, GGG, we own. We have bought it. It's migrating back to the 21-day moving average. Sorry about that. Genpact is one that we might buy based on a very similar profile. But GGG, we actually are migrating back to that 21-day moving average. Not a lot to worry about. Our stop is actually all the way down at 78.50. We bought it at 79.45. if it closed below the 21-day moving average at all, we would probably sell it and take our 1% gain or something like that. And go, well, I don't know about that. All right, HCSG. Bought that this week. And so far, we're doing okay. Up 0.47%. Only bought it on Friday, I believe. And so we are headed back the opposite direction. If you want to look at, a good year of HCSG, we like the fundamentals. Of course, we don't buy things that we don't like the fundamentals, which means that we don't end up in a lot of stocks that just simply have momentum and no fundamental underpinning it. So this is HCSG. We liked the look of that turn right there. HP, probably going to take it off the list now that we've talked about it. We sold it at $28.91. It did get as high as into the low 32s, but the amount of volatility that you paid after that was pretty elevated. Like when we sold it, by the time we sold it, the volatility was almost 63%. That's still pretty high, whereas back over here when it was doing a lot of the earlier rise, it wasn't nearly as high of a volatility. It was more like 30 to 40%. Got to remember, you're paying volatility for the amount of return that you're getting. These are risk-adjusted returns. So you're dividing expected return by measures of risk. And once we get up into that, 62% range, that's pretty high volatility. We're paying a lot of volatility for expected return. And earnings are coming, so we can't control that event. So we sold out. Did pretty well, actually, on that trade for our purposes anyway. Sorry, need to probably take that off the list for now. It stays in the tank. Just so you know, I have another list. It's the tank where I keep them in a holding tank, and I trim that and add to that here and there. You don't see that. We pull it in and out for the show, but that's kind of where it goes. Now, IBM was a discussion item this past week. I posted this on the Facebook page. IBM did this gigantic, massive gap down. This is all news that IBM's getting in the AI game, and then suddenly, just unexpectedly, we made some money off of it and just sold it. At the moment, we felt a little bit silly because we made over 10% on this move. You can calculate those from 259.32 to 292, and we were happy for the move, but it had been so much higher. And so for a moment, it was kind of an all shucks sort of moment. But, we did all right. And then it did this cup, and we were looking at it again. We were even talking about it. And then all of a sudden, unexpectedly, IBM pre-announced their earnings, and it just gapped down hard like this. And during this ride lower right here, someone posted on a Facebook page that it hit 217 somewhere right through here. The person said it looked like a really great price, and so they were buying, which isn't terrible fundamental analysis. If you dig into the fundamentals, we're not doing that right here, but isn't terrible fundamental analysis, but is absolutely horrible trading technique. And which is to say, it's essentially the lack of any existence of a reasonable trading technique. And I actually went and posted a whole analysis on it. I was like, it could rise. You got earnings coming, that could even dip it a little more. Yes, they pre-announced the earnings. We don't know what's going to happen. And honestly, IBM, we just don't, I wouldn't just go buying it right here. It's still headed down. And person, took it in stride. And then the earnings came and IBM turns, right? Goes on right here. So from then to now, IBM has risen from, it of course went down from that 217 area. You had to weather this, which we would not have because we use stops and directional trading. Like we wouldn't have bought it in the first place anyway, but we would have gotten stopped out. And then back, recovery, and a little bit of this and everything, all the way up to where it is right now, just short of about 235. And the person was all too happy to post last week that my comment didn't age well. Here's the problem with that, and that is that we still don't have a DI plus above a DI minus, have not through that whole rise. And we still don't have an RSI above 60 that would show a strength in the rise. I congratulate the person for, a profit, because a profit's a profit, and that's a good thing, and we think that's fantastic. We want everybody to make a profit. But what that's saying to us is that institutional money is not pouring into it. That's retail money, which is going to be some of the most fickle money there is. And to us, it just didn't show the strength of an up move. And so we're still waiting for IBM to show us a reason to believe. And thus, it is on the list, and we're leaving it on there, but it rose above the 21-day moving average and has begun consolidating right here in a small daily consolidation. We're going to leave it on the list. We'll see what happens. But that's kind of the story. And all that took place. We actually continued the discussion on our Facebook page. I don't think anybody chased us over there. IIIN, IIIN in steel. We are still waiting for a buying point. We would need one down in the lower quarter of this regression channel. Earnings were back here in mid-July. If we don't get one pretty quickly, it just seems like we should. Some touch right in there, because again, we don't want to get stopped out. But it seems like that could be something that worked. Now, let's go to the gold trade. All right, KGC is a gold stock that we really like to watch. In the news, like the Wall Street Journal and Barron's and Market Watch and these Bloomberg and these folks, their favorite seems to be, let me scroll down here, Newmont, right here, NEM. Okay, they are very similar as far as their fundamentals are concerned. Newmont, NEM, probably more often than not, probably has a little better profitability. They're priced very differently. Newmont's $117 a share, whereas Kinross is $27 a share. The share price is commensurate with the amount of revenue that they make per share. It's just the way it is. News kind of likes Newmont a little better because it's bigger. We like Kinross, partly for the share price. It works real well. Got into another discussion with someone, and I won't get into all the details of it on another Facebook page, but got into another discussion where someone had bought exposure to, not very well thought out exposure to gold, but bought exposure to gold down in this area right around in here before this gap up. And it worked out. It worked out for the person, especially since the person had taken exposure using a 3 times levered ETF exposed to junior gold miners. This was more akin to gambling than actual investment, but it worked out. And again, we congratulated the person for it working out. But for our purposes, we now have, so if we're looking at Kinross here, only after the cross of these moving averages and this downtrend line do we actually have a leap of the DI plus over the DI minus, which has held, and an RSI above 60, which also has held. It's pointed down a little bit lately, but it's also held. And so we are waiting in this consolidation. But remember, we're below the 200-day moving average here, and gold has been selling off for months. I mean, if I had to have a theory about this, my theory is that gold probably is going up from here. But the problem is this: I'm not buying in right now because I don't see the move happening in the way I need it to happen. I don't have to catch absolutely everything. And we have lots of discussions here in the 10 Mil Club room about this sort of stuff. So what we're waiting for is this base to be broken out of so that gold really resumes its upward trend. It's that way with KGC, Kinross, and it's that way with NEM, Newmont as well. So we are watching both of those. We are just not gamblers. We are positional investors, and that's just the way it is. All right, so that's the gold talk for the day. KLC. So we have been watching KinderCare, KLC, because honestly, I brought it to the group. Groups talked about it. It seems like a good recovery play. The for some reason, the market just, we didn't buy it. It sank into earnings, and that gave us great concern. We do pay attention to whether or not, because honestly, I'm pretty sure that insider trading is one of the least prosecutable and most difficult to chase down things there are out there, because it sure looks like people know stuff in advance. And when that started falling into earnings, it just became a great concern. Now, we didn't own it. We didn't do it. You can see there's nothing on the screen here other than drawings and things we have. It was above the 200-day moving average, and on that day, it just tanked and continued going down to the point that it's now $2.60 a share. We're going to keep an eye on it because it's of interest to us, but we are almost certainly not buying that this week. And it says here they swung to a loss, and they have new leadership. There's a lot they need to do, and we've read deeply about the child care industry and how, like, the difference in 86% occupancy and 93% occupancy is just this massive amount. It doesn't sound like that much, but it is. And KinderCare has a lot of work to do in that way. Honestly, KinderCare could easily be a very valuable stock in the next few years. We're just not the kind of investors who buy a bunch of it and then just sit tight. So this is one of the few penny stocks we really watch, but you probably won't see it on the list again. In fact, I'm going to take it off the list right now because we almost certainly are not buying it this week. That brings us to LMT, Lockheed Martin. There are two here, LMT and RTX. Here's RTX and LMT both. Now, LMT were up 2.3%. RTX were down 0.25%, 0.25%. The thinking here, both of them showed us the technicals we wanted. You know the technicals we want. Take a look at it. There's a narrative out there that with the Iran war, Iran has actually been more resilient than the United States military really thought they were going to be. And that's a conversation for, a different forum. But the thinking is that the United States military is going to have to order a lot of Patriot missiles, and the two companies that make those, or at least two major companies that make them, are RTX, which used to be Raytheon Corporation, and LMT, Lockheed. And so far, Lockheed's trade has worked out. We're up 2.3%, and so far we're only down just a touch on RTX. So doing okay so far. All right, Mattel, M-A-T. Mattel is now past these earnings, and the earnings didn't seem to, now we didn't buy it going into these earnings, but it actually seems like the market just kind of took the earnings in stride, despite the fact that the earnings weren't the greatest thing on earth. Mattel is, of course, a toy company. The idea with toy companies these days is that they don't just want to sell toys in the toy aisle. What they also want to do is become a partner in media. Like, for example, Mattel owns Barbie. And a couple of years ago, we had the Barbie movie. And think what you will about that movie, whether you liked it or whether you didn't. The coverage was to get, the idea was to marry a movie with the Barbie doll and create new interest in selling toys. Mattel actually has several other brand partnership type movies in the works. My understanding is there's one on matchbook cars that they have that's in the works. None of them have set release dates as of yet, but it wouldn't take a whole lot. Their fundamentals really aren't horrible. I mean, it's the company actually looks decent, and it's now kind of riding this low level, and now it's above the 21-day moving average. We're past earnings. We are still underneath the 200-day moving average. So whether we buy that or not is somewhat up in the air, but it's on our watch list. MCD, McDonald's, only looking at 6 months, but if you look back, McDonald's has actually traditionally been something that was very valuable. A lot of real estate in this company, a lot of revenue in this company. They're having to work against some inflationary things and stuff. We are, as positional stock traders and investors, are looking for some higher swing highs and higher swing lows. We have the higher swing lows in what appears to be a forming consolidation pattern here. We also have lower swing highs. So as of yet, we haven't broken out of this. It could break out of this consolidation pattern, go either way, up or down, and we're willing to allow some of that to simply happen. If I had to guess, my guess is it's probably going to be bought through here. Like you can see in this consolidation pattern, you can see the volume letting off as it does that. Quite often that means that the supply of shares is drying up and the stock should go up from here. There's a lot of chatter about this online, and rightly so. Big company, a lot of value that you can get. If I had to have a theory, I would believe it's probably going up from here. But again, we don't know where the market's going. We're going to follow the market. We just don't have enough money here at TMC to move the market. So we are going to watch that for a little bit longer, but it is on deck for us to pay attention to. MDT is Medtronic. Medtronic, let me back up to a year here. Medtronic sold off pretty badly there for a while. Then these earnings gapped it up. It consolidated through this area right through here. We didn't buy it. Probably could have. And then it broke out of that pattern, cupped, and now is above the 200-day moving average. We may simply buy Medtronic this week and let it roll. MWA is Mueller Water. Now, fundamentals on this are really good too. Why Mueller Water is so sold off, we really don't know, but we are now beyond earnings. The earnings didn't look too bad. We're migrating back to this $25 line, which is actually a resistance level. Turn at that resistance level, we'll probably buy Mueller. And don't know exactly what we'll do with it. I know you're probably supposed to go into everything with a solid plan, but at 25, we should be able to make some pretty good money off of it. So Mueller's on deck. P-A-Y. Paymentus Holdings. If I had to guess, I would believe that Paymentus probably was a victim of AI is going to replace everything. So if we go back and look at a couple of years, Paymentus, they were doing pretty old well and then sell off. They now have really good, and again, fundamentals are good on this company, and that's a pretty serious rise from the 20s all the way up to the 40s. But and extended well above the 21-day moving average. But it's this that's of great interest. These are the earnings on August 3rd, not very long ago. We have a gap up. We have a decline with a dry up in the volume right through here, and then a move higher. We may simply be buying Paymentus Holdings in the next day or two, just simply on the strength of that outlook right there. PCTY is Paylocity Holdings, and that one, very similar thing. Probably was an AI is going to replace everything in the world. We crossed back over the 200-day moving average and our downtrend line right here. 50 days coming up to it, 21-day MAs here. Got lots of solid strength moving up. May actually be buying PCTY in the next few days. Progeny, PGNY, we actually sold this for a small loss going into earnings, and it was a good thing we did. The technicals had just kind of deteriorated, and we just went, you know what? And RSI was lacking through here, and we just went, you know what? We don't know what's going to happen. Could go up, could go down. We don't know. Earnings really weren't all that bad. The reason we're keeping it on the list is because it, of course, gapped down. You can see it here, and then closed after. Gapped down here, went down a little further, and then closed higher right there. That's the dead cat bounce. Came up and then came down, but did not take out that swing high right there, and has now begun consolidating at a low. Company's not bad. Earnings weren't necessarily bad. I think they did lower their sales guidance a bit, and that is a sin right now. Market, it's an overbought market. A lot of institutional money knows it. If you don't have strong growth, you're not going to outperform the market. And so lowering your sales guidance is quite a sin right now. But if we go to 1 month, 1 hour, like this, and you can totally see the upward move right there. And so we are keeping an eye on that because we will buy back into Progeny if it shows us enough move. Right now, we kind of have negative technicals, and we don't have to catch everything else. But a move from 27 or even 28 up into these mid-30s is actually a pretty handsome move. PRGS, we may simply be buying this. We've been waiting for a little while for a tick back to this 21-day EMA. This is another one of those software companies that AI is going to destroy everything. Oh, wait, not that one. And so this one, you can totally see the, the DI plus over the DI minus. You can totally see the RSI up against, the highs here. You can totally see it outperforming the S&P 500 over the last little bit in relative strength. And we honestly probably, I think it's being accumulated. We'll probably just buy it, even if it doesn't come back down to the 21-day EMA. RRC is Range Resources. That is our one oil and gas play. It's more of a gas play than it is an oil play. And this was a tense moment about a week and a half ago, and it came right back off of it. Of course, we had more Strait of Hormuz problems, and here we are. We like this company because it actually, they know what to do with the money. We may need to find a petroleum play. In fact, I'll make myself a note once I get off here to find ourselves an actual oil play as opposed to just a gas play. But RRC up 2.13% so far. We're doing okay. Sirius XM Holdings, SIRI, we got stopped out. We're going to keep it on the list for this week because it's down and it's making a turn right here. The fundamentals, you might think, really? Sirius Satellite? Well, the fundamentals look pretty good. There's a lot that they're doing to like, and they're kind of beyond a big capital spend regime. And it's being bought by some large institutional investors. One of them is Berkshire Hathaway. So, and of course, we wouldn't buy it just because Berkshire Hathaway was buying it, but the stock has been rewarded for the improvement in its fundamentals. And this may have just simply been an algorithmic sell-off or a large investor selling some shares. And that's the way it is. That's fine. We would still buy it. We bought back TSFL this past Friday. We ended up down 0.06% on TSFL. It looked like the banking industry stocks kind of took another turn, and we bought it back, and we'll see kind of what happens. TJX is back on deck. This is the parent company for TJ Maxx. We did a deep dive on TJX, Burlington, and Ross Dress for Less. That's still on our channel if you'd like to go see it. It's a few months old now, but it really pretty much still holds. If it turns at this swing low, we may actually be buying back into TJX, even though we got stopped out right in here. But we like TJX. We actually do some shopping at TJX. Of course, never buy something just simply because of familiarity bias. That's not a good way to invest. Now, TMC, the metals company, we only watch this because it's our mascot stock. This is not the kind of stock that we watch around here. However, I am going to do a penny stock spotlight on this stock. It rose into earnings, and we got quite a bit of traffic on our channel because people wanted to know about this stock, TMC, and then the market didn't like the earnings. I'll talk about this a lot more in the penny stock spotlight, but the truth is we've gotten one comment recently about this stock, and if you are out there watching me and you're the guy who made the comment, thank you for watching our channel, and please give us more comments. But the truth of the matter is, let's look at 2 years of this stock. At some point, yes, that stock could lurch and go right on up, but is that a way to invest that makes like consistent sense? There's a penny stock back over here. It has no earning or no revenue and no earnings. It's, you might say it's pre-revenue and pre-earnings, but like we don't know when it's going to. And it has these swings and things like this. Lately, it's been just kind of slowly drifting lower. We don't know when they're going to get their license to mine rare earth minerals off of the ocean floor 2,500 miles southwest of San Diego, California. We don't know that. We do know they bought some royalty rights from an iron mine in the Mesabi Range in northern Minnesota, and good for them and everything. And I think maybe some of the disappointment here was that there was kind of an expectation that with those royalty rights, they might now actually have a little bit of revenue, and that would shoot the stock up. And there was no revenue. I looked through the earnings. I don't think there was any revenue at all. Correct me if I'm wrong, because I can handle it. I'm a big boy. But anyway, I just see that stock. I don't know where stock's going. They could announce something tomorrow and it could shoot up. But the truth of the matter is that a consistent way to invest? TNL is Travel and Leisure. This was actually Wyndham, make sure I get this right. This was actually Wyndham Destinations that changed its name to Travel and Leisure. They sell timeshares. And as much as you might like or dislike timeshares, the truth of the matter is their fundamentals actually look pretty good. Share buybacks, low and handleable debt, operational efficiencies. Whatever it is they're doing, they do it, and they do it pretty well. And they've hit this resistance level kind of around this. This is some kind of sell-off that has to do with earnings dive and then the stock trying to regain its footing, and then it ran a bit. But this 72.50 area right here seems to be some sort of a resistance level. And the fundamentals look so good on this that if we get an opening, we might actually buy TNL. TOST, TOST. Okay, this one, it says here, cloud-based technology platform for the restaurant industry. All right, I'll look at 2 years of this real quick. Now, I think a lot of the thinking on this was, that's a software company. They're going to do great. Oh, no. AI is going to eat their lunch because AI is going to destroy everything. Wait a minute. They seem to be doing okay. Not that one. And then up they start going. So Toast, we may actually buy this without a full migration back to the 21-day EMA if we can find an entry level. And the reason is because the technicals are so good. Like, this was overbought. This is red over 70 right here. And then we're still at 63 RSI, DI plus over the DI minus, outperforming the S&P 500, upward momentum for miles. And, anyway, we like Toast, TOST, so we're looking at it. WLY, this is John Wiley & Sons. This is the book company. I think bubbling under the surface on WLY is that they're using AI, and I don't understand exactly how. But if you take the word AI and you combine it with human waste, all of a sudden that human waste is not only not a liability, now it's worth $1 million. So, if you can figure out a way to take dog poop from the street and say it's AI dog poop, you would all of a sudden have, $500,000 worth of dog poop. So they are, I don't know the extent to which they're using AI, but I think that's bubbling under the surface, and that's why we may actually buy it right here, because it just ticked right back above the 21-day moving average, and the technicals flip back the way they want to. That's not a very high RSI, I will say that. So if you don't see us buy it, don't nanny any boo-boo us. Okay, YETI, finally, YETI. YETI is the company that sells, water bottles and similar type things. I did not know, to be honest with you. I know this very top news here says Tiger Global Management decreases their stake by almost 1,200,000 shares. I get that, but the earnings just were not horrible for YETI. They were actually pretty good. They really know what to do with money when they get it, and their fundamentals look very, very good. We're not going to just buy a gap down stock on earnings like that. What we're going to do, we have it on deck because we're going to watch it for the next few days to see if stock finds a footing and then shows some upward mobility and can kind of regain its footing, because to us it looks like it could be a really great opportunity. So that is the way we see it. Thanks so much for watching our video from all of us at the 10 Mil Club control room, and especially our singers Sophie Hannah and Presley, and our announcer Jackson. We will see you next time on the
10